Hi everyone, I am Asif Iqbal, business lecturer at Scholar School System. I'm here with you today to explain the PowerPoint slides of Week 1, Module BMM5412 Financial Management. Contents of Module Handbook, which includes Module Name and Code, Module Leader Contact Details and Availability, Module Team Contact Details and Availability, the Learning Outcomes for Financial Management, the Assessment Deadlines, assessment criteria grade, resources, academic support, feedback, essential library and learning resources, a module at class, teaching and assessment. All these contents are available in module handbook, which is already uploaded in the Moodle. In this, I will cover learning outcome 1, which is regarding to formulate appropriate measurable financial objectives and review financial performance against targets, using appropriate ratios to assess the performance of the company and to identify potential corporate financial failure. First of all, I will discuss with you difference between finance and accounting. These are different parameters to make a difference between them, like the purpose, responsibilities, basis, external reporting, internal reporting, financial decision making, financial analysis, and legal compliance. On the basis of this one, we can make a difference between accounting and finance. Financial statements. There are four financial statements used to communicate information to external users, creditors, investors, suppliers. First one is the income statement, then the balance sheet and cash flow statement and statement of owner's equity. Income statement. Income statement covers a period of time which summarizes the revenues, expenses, and reports the net income, which can be calculated by excess of revenues over expenses. If the net income increases retained earning, then it should be the profit, and net loss will decrease the retained earning. Balance sheet. Balance sheet shows the financial condition of an entity as of a particular date, which includes the assets, the resources of the business, liabilities, the debts of the business, equity, the owner's interest in the business. And the accounting equation is assets is equal to liabilities plus owner's equity. Cash flow statement. Cash flow statement covers the same period as the income statement and has three sections: cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. Statement of owner equity covers a specific period of time which reconciles beginning and ending balance of the owner's equity, accounts like capital stock, retained earnings, and it links the income statement and the balance sheet. There are different accounting concepts. First one is a business entity concept, which assumes that the business and its owners are the two separate entities. The business and the personal transaction of owners are separate. The other next concept is a realization concept. The concept states that the revenue from any business transaction would be included in the accounting period when it is released. The term realization means creation of legal right to receive the money. Matching concept. The matching concept states the revenue expenses incurred to earn the revenues must belong to the same accounting period. So once the revenue is released, the next is allocated to the relevant accounting period. Going concern concept assumes that the accounting entity will continue for indefinite time that allows to business to defer their certain costs that are to be charged against the revenues of future periods. The last concept is a dual aspect concept, which provides that the basis of recording a business transaction in the books of accounts, it assumes that every transaction have a dual effect. Means that the transaction should be recorded at two places. One is debit, one is credit. Every business have some financial objectives. Some of the listed down here: increase revenues, achieve a net profit margin, reducing operating expenses, improve cash flow management and maintain positive cash flows, achieve return on investment or reduce debt. Corporate governance. Corporate governance defines organization power structure, accountability, and decision-making process. It is essential that enables management and the boards to run an organization more efficiently and effectively. Environmental awareness, ethical behavior, corporate strategy, and risk management all are the aspects of the corporate governance. The purpose of the good governance ensure that business have the appropriate decision making process and controls to ensure that all stakeholders are balanced. At the corporate level, governance involves setting and achieving the company's goals while considering the social, regulatory, and market context. Issues in corporate governance. Conflict of interest between stakeholders group, defeat of corporate strategy in conflict with corporate objectives, no fixed external policies for effective corporate governance, transition issues on merging of management cultures as firms becomes multinational. Some OECD principles of corporate governance are provided that ensure the basis for effective corporate governance framework, the right of the shareholders and the key ownership functions, the role of the stakeholders, disclosure and transparency, the responsibility of the board, and the equitable treatment of the shareholders. These are the references listed down in the slide from where all the information is provided in the previous slides. Thank you very much, everyone. And if you have any question, my email address is provided in the module handbook along with other lecturers. Then you can ask the question. Thank you very much.